Awesome. Well, hey everyone. Thanks for joining Anjan here with Verify Capital. Super excited to be here with Jim from Superstate. And full disclosure, we were seed investors in Superstate, so just want to throw that out there to start. So, anyways, I guess just to get things started, I mean, super interesting time in crypto and I would say in tokenization in general. And we have one of the leading companies, if not the leader in this space, on the call here. So I guess just to kick things off, Jim, if you want to just give a quick introduction on yourself and Superstate, and also just why tokenization matters. I mean, it's a word that's thrown around. There's a lot of stuff going on in the space, but I think maybe not everyone understands the actual benefits and how disruptive this technology is. But I'll turn it over to you for a quick intro.
Yeah, thanks, John, and hey, everybody. Really great to be here as part of this really exciting time in crypto markets, broadly speaking. So yeah, Jim, I'm one of the founders of Superstate, run business development. Was at Compound before launching Superstate with Robert Leshner, one of the pioneers of DeFi as a category. But prior to that, spent a lot of my life in traditional financial markets. So have seen kind of the evolution, from being at a big bank into fintech, into crypto, and the convergence of kind of all of that experience is what brings, tokenization to life today. And so, we started Superstate about 3 years ago where, we wanted to address the need for upgrading financial markets so that there's better technology, better investor experiences, and much broader global access, which really I think are the three kind of areas that tokenization improves from traditional capital markets to, when you bring assets on chain. And really the kind of light bulb went off for us at Compound when we were looking at, how efficient smart contracts were managing risk, being extremely transparent, creating a global marketplace. Whereas, traditional financial markets and even some of the centralized platforms in crypto, you have very limited visibility and extreme, opacity around where the risk is in the system, as well as gatekeepers that allow folks to participate in certain markets. And so, Compound, despite, a lot of deleveraging in crypto markets during, the bear market of 22, continued to operate exactly as anticipated, with risk being efficiently managed, with transparency, 24/7, no need to go through a spreadsheet and kind of figure out where the risk is in the book, it's there on chain, and, was able to continue with no bad debt on its books throughout a really large drawdown in the markets. And so I think the genesis of Superstate was looking at that and say, how can you apply that technology to things like fixed income, to equities, to real estate, to, structured products, and, allow the amazing, the convergence of stablecoins and smart contracts to be applied to securities. And so you bring those three S's together and that's basically Superstate. And so, we've been on this journey for a number of years, but tokenization broadly, is a way for assets to, more efficiently reach between issuers and investors, to have secondary markets where assets can move 24/7, where they can be programmatic and have rules built into them that are, extremely efficient at execution and instant. And, the proliferation of stable coins as the digital dollars that underpin all of this makes, settlement, redemptions, subscriptions, transactions, and all of that tied together in a financial system that, is dramatically improved from the legacy where there's about 17 intermediaries involved in any given transaction. Instead, you allow peer-to-peer transactions to take place using, what blockchains are great for, which is a decentralized network of individuals and institutions that can all interact together using now real-world assets and not just crypto-native assets.
It's great. Great overview. And as you look at the tokenized treasury space, going deeper into that specifically, it's been pretty remarkable to see just the growth over the past 2 years, right? We've gone from basically zero to 15 billion plus. I'd love to get your perspective on what's been driving some of that growth. But as we think about, going from 15 to 100, what do we have to believe? What are the unlocks that have to take place? Maybe it's the product side, maybe it's regulatory. So yeah, maybe if you could comment on both the past 2 years to get here, and then what does it look like to grow another 5, 10x from here?
Yeah, absolutely. It's been amazing to see the growth, but to put it in perspective, there's like $30 billion of treasuries that are on chain tokenized today in various different forms and functions. But in the US, total money market fund assets are like $7 or $8 trillion. So there's a lot of work to be done to get to a comparable scale as TradFi. But all that being said, it has been on a relative basis remarkable growth over the last few years. And I think it comes down to demand, which has really been Superstate's thesis. Like you could tokenize anything and hope that there's a buyer or a market for it. But what we recognized is that treasuries had a few properties that were in demand from already crypto native investors. And so the first one is stability, right? Especially as I was mentioning, during a time of high volatility, you've got assets that are whipsawing around in crypto markets. There is a relative safety that's required for institutions or for retail investors that want to be able to park their assets into a stable asset. And treasuries are extremely stable, especially when you talk about T-bills. And specifically, that's at the short duration, like kind of front end of the curve. So despite the movement in interest rates, like the price of a treasury bill is relatively stable because the maturity is so near in the future. The second property is yield. Everybody in crypto loves yield. And so if you look at the relative yield between what a treasury bill can pay versus what you might be able to get for lending USDC in a market, or even versus no yield by just holding a stable coin, the benefit to an investor that's looking to have a cash-like return or cash-like, investment, which actually provides a yield, T-bills really fit that need in a way that doesn't take additional counterparty risk or protocol or smart contract risk, and also compensates you for holding that. And so, stability, yield. I think the kind of third part of this is just like really on the buyer side. There's actually been, because of the growth of stablecoins, a lot of those issuers that are crypto native and are backing their reserves with T-bills are big buyers of these products as well too. And so you've seen a lot of products like Superstate is one of the reserves behind Bridge, for example. Bridge was bought by Stripe. They built a stablecoin orchestration and origination platform that basically allows for the creation of stablecoins. They want to park their assets and reserves into a very high liquid, yield bearing asset, and by mandate really have to be into T-bills so that they can maintain the peg. And so the demand side of stablecoin issuers looking to hook into T-bills, they want the functionality that they're used to, which is being able to programmatically subscribe and redeem and being able to show their reserves on chain 24/7, because these are tech forward businesses that are looking for these types of tech forward assets. So, that is one category. There's a number of venture funds and hedge funds that, again, when they go risk off and they're, maybe sitting in cash, they want to be still earning yield, but they don't want to wire money to a, account in TradFi. They want to be able to do it on chain directly. Corporate treasuries that are, large institutions that are, running a business but have USDC, let's say, on their balance sheet, and they're looking to have, yield for their treasury as they manage just the corporate finances. So these types of buyers all exist, and I think that's where you've seen the growth in T-bills as the building block for a lot of these different types of buyers. Now, what's interesting is that also creates a new category of DeFi users. So when you look at things like Camino on Solana or Aave Horizon on Ethereum or Morpho on Ethereum and Base and others, you have these markets that allow you to use your assets as collateral. And what we've seen very recently in like the last probably 6 or so months have been securities like USTB, our money market fund, being integrated as collateral in those markets. And so this now starts to go from just a balance sheet asset for a investor to a productive collateral asset. And when you think about how investors in traditional markets move assets around for collateral, it's quite clunky. They have certain platforms that they can post collateral to. There's margin calls that require a certain window to settle, to settle in, and that's a Monday through Friday 9 to 5 type of a window. But with a 24/7 DeFi market, you now open up collateral mobility for an asset that can move 24/7 instantly. And so as we look forward towards like where does treasuries really go, aside from just being a balance sheet asset for investors that are looking to get the stability and yield that I described. It's now becoming a productive asset where large institutions are thinking, okay, when I compare and contrast the TradFi movement of treasury bills to the DeFi movement or on-chain movement of treasury bills, it's a dramatically different financial system that can be built, which is more capital efficient with less risk and more transparency. And so that's, starting a journey of, allowing those types of use cases to proliferate before we start to, expand from treasuries into other different asset classes. But it's really, creating the bedrock. And that's where, to your question, to go from 10 to 20 billion to a trillion or more, it's really the utility that tokenization unlocks that will be the inflection point for traditional institutions to leverage the technology versus just crypto native institutions.
It makes a ton of sense. Yeah, I mean, if you think about it, tokenization is really just like clicking a button. It's really like what can you actually do with the asset,
Yeah.
the composability and the movement that makes it quite compelling. Um, for those that aren't, I mean, a lot of people in the audience may not even own a tokenized treasury or a tokenized asset yet. What does the actual onboarding look like with Superstate in terms of like how does one actually get onboarded, and how does that onboarding process differ from, let's say I have a brokerage account today and I click, hey, I want to buy U.S. treasuries. What does that look like today from an onboarding perspective?
Yeah, it's a great question. So we built our own onboarding experience because we know that everybody hates the word onboarding. It's got this like negative stigma. It sounds terrible. We just decided to build some technology to make it extremely, friendly. Um, but the underpinning, the actual asset itself is a private fund. So USTB, our money market fund, is a private fund today, which means that only qualified purchasers are eligible to invest in this. And it's a U.S. domiciled, registered, or well, exempt security that requires us to make sure that any holders of the asset are qualified purchasers. So, there's a standard KYC, KYB that our clients have to submit in order to get on the whitelist of addresses that can interact with the asset. But as we start to go towards a registered security market, then the barriers to entry start to reduce. When we first launched Superstate, actually the first product we pursued was to go to the SEC and say, hey, we're a fintech company building a registered security on the blockchain in 2023 before we have this new regime in the political environment in the US. And of course, we were told that that was a futile effort from the prior SEC. And so now we have a much more accommodative SEC. And so I think you'll see much more attempts from innovators that have been building for a long time in the private fund world start to move towards registered products, whether it's funds, ETFs, stocks, and other types of securities that can take the learnings for the last few years and apply it to a security that's registered, which is now available to a much broader audience. And so I think when you contrast what it looks like today, and you asked about this, Anjan, specifically, like you have a brokerage account where you've onboarded once, and then every available security that's been registered is basically available at your fingertips to the extent that that broker supports it. The same type of access, and the reason why is because like all of those assets are registered securities, and so you have, very easy entry to a publicly registered security that already has filed all the necessary, prospectus and information with the SEC, and so you as an individual have a broad access to that because the disclosures are public to you, and so historically, the SEC wasn't comfortable with allowing those types of registered securities to have tokenization components to them. But now that's starting to change. So, Securitize and BlackRock put out a proposal, Bank of New York Mellon with BlackRock, Wisdom Tree, and there's a number of others that are, starting to get out to the SEC to offer registered securities with a tokenization element. Once that happens, then I think, the broker dealers that everybody is used to working through today, or even other access points of non-broker dealers like other fintechs or wallets or whatnot, the barrier to entry will reduce where that KYB is no longer hey, are you an accredited investor with a lot of information to fill out? It's more or less, did you read the disclosures and are you a non-sanctioned individual? And so therefore you're allowed to invest in this. And so then the available menu of options to investors will be a lot larger. And I think that will then in turn bring in more and more users because today you have a very finite, limited set of a TAM for us to distribute our products into. And once that opens up to a broader universe of investors with lower onboarding friction, then you start to get more velocity and more demand and more users that start to interact with these assets, but built on top of the rails that, the private funds have demonstrated thus far.
Got it. So want to also move away from tokenized treasuries in a bit, but just to round out um, the treasury side, when you're talking to these venture funds, these CFOs, these traditional institutions, I'm sure you get some pushback from folks, right? I mean, all of us in crypto and kind of builders and investors in the space see the benefits on tokenization. But I'm curious, like, what's some of the pushback you get from these folks? How do you kind of address that? Yeah, would love to understand some of the pushback that you get on whether it's tokenized treasuries or just tokenization in general.
Yeah, I mean, just speak to tokenization in general. I think, the main pushback from an allocator perspective, if you're not a crypto native allocator, has been, why would I take smart contract or tokenization risk on top of an asset that I already have access to? And so, that is a very fair point to a very traditional CFO of a Fortune 500 company that doesn't have any stablecoins. I think that's going to change a ton when Genius happens and there's stablecoins on the balance sheets of these managers. And so, Invesco taking over USTB, the fund that we run today, starting on Monday, they'll be the manager and the distributor of that product going forward. And their conversations with their large CFO, Fortune 500 clients are already starting to say, what do we do when we have USDC on our balance sheet? And so the answer is, well, you could burn it, you could wait a couple days, you could send a wire to buy our old money market fund, or you could just buy USTB through a smart contract directly. And so that's when the light bulb goes off to a more traditional allocator to say, okay, this is an operational efficiency. And the tokenization side of it is, well understood, given the growth of the industry, the amount of people that are using these products, the fact that the technology is not 3 days old and it's 3 years old and soon to be 5 years old, right? Like, I think that maturity is just necessary to bridge that gap. And I also think, my last point on this will be that the experience for an allocator today is very much, I have to set up an Anchorage, I have to have USDC, I have to onboard to Superstate, and I have to do this transaction. Imagine that all goes away when, your existing custodian, if it's Bank of New York Mellon, or if it's, some prime broker that has a digital wallet embedded inside of it, and you as the CFO click a button and say, I want a money market fund, you're not going to necessarily know that underneath the hood, that transaction is done through stablecoins and tokenization, but more from the infrastructure side will be abstracted away. And at that stage, we, kind of go across the chasm from the crypto native person who already has stablecoins in an Anchorage wallet and is onboarded to Superstate into a broader market that's embedded into the existing financial system.
Got it. Yeah, it makes a ton of sense. So shifting gears away from just treasuries, as you just look at the tokenization space in general, I mean, you've seen this massive growth in tokenized treasuries. There's been tokenized commodities, right? Gold has seen a big surge. You have private credit. You're seeing the tokenization of Pokemon cards and watches. So you're seeing dozens of different asset classes get tokenized. I'm curious, like, what are the asset classes or just assets in general that you think benefit the most from tokenization, right? I mean, I think sometimes people think tokenization is a end-all solution for every single asset, but it'll have different effects on different assets. So I'm curious, like, what are the next sets of assets that you're focused on outside of treasuries, where you think this technology kind of uniquely disrupts or adds additional value for a lot of customers that may already hold these assets today off-chain, or have wealth on-chain and may want to diversify that into tokenized assets.
Yeah, so I look at it from two different perspectives to answer your question. Like, one would be from the current allocator demand set, the first exposure that they wanted to get access to that they couldn't was treasuries. And so they're now beginning to diversify their portfolio up the efficient frontier. So they're saying, I want, today treasury bills are very liquid, they have good enough yield, and so we can put a majority of our balance sheet into that because we're needing cash on a regular frequency. But at the same time, the whole concept of ALM, right, asset liability management from a treasury management perspective says that you don't need to have all of your assets at the front end of the curve if you don't need all that liquidity every single day. And so what we're seeing is diversification up that risk curve where folks want maybe investment grade fixed income, high yield fixed income. Private credit has, of course, gotten a decent amount of traction thus far. AAA CLOs, and there's various other asset classes along that curve that just give people that balance sheet exposure that they're looking for, which says like I don't need all of it to be at a 3 handle, but maybe I want some of it with monthly liquidity with a 5 handle, and then quarterly liquidity with a 9 handle. So we're excited that like in our business, we have our treasury bill fund, we've got our carry fund, which is the basis trade, which typically has a higher yield when market's a little bit more bullish than they are today. But then we've got now our first external fund issued on Superstate, which is Coinbase Asset Management, and they have a stablecoin high yield fund that basically meets that quarterly 9 to 10% yield category for an investor, which is now giving a broader array of things for people to invest in. So I think on the fund side, you'll continue to see a journey along that risk curve where folks will bring more and more assets on chain from specialized managers that have those strategies either today or that are building new strategies through these channels. The second vantage point that I look at is like, why do you tokenize something in the first place? It's like actually, part of it is just to reduce the amount of intermediaries that are involved in a given transaction. And so one area that we separate to our funds business are focused on is equities. And everybody is looking at equities these days. And there's a couple of different ways to approach equities. There's the wrapper approach, which is gotten a lot of traction today. You've seen an explosion of secondary markets built on these wrappers, which is exciting. But at the same time, it doesn't really solve the problem of tokenization. What it does is it gives people access to have exposure to Tesla or exposure to NVIDIA that can't access it in a brokerage account today. So like solves a need for a client or a user, fantastic. But at the same time, the way that that's structured is a SPV or some sort of a structured product that is on top of the existing system. And so you don't really compress any intermediaries. You actually add another one or two on top of it. So that's not necessarily changing market structure. That's just creating new distribution. The second way that we've seen is the DTCC, which has gotten a lot of attention, which is taking their existing model and adding tokenization to it for the members in their universe. And so the analogy I like to give there is they're Saturn and they're building for the rings around Saturn, but they're not necessarily thinking about all the other planets in the solar system or across the galaxy or across the universe. And so what Superstate is doing is the third model, which is the most flexible model and really compressing a lot of these intermediaries down to none. And so when we think about equities, today you've got a lot, at least in the US, in DTCC, which is like the vault, basically it has like 100% or close to it of all equities. And then you've got broker dealers, and then you've got investors. Like very simply, let's just say it's those three layers of the cake. What Superstate does on the equities business is we actually collapse that down to just the issuer and the investor. So the company issues an equity, and that token that's held in a wallet on Solana or Ethereum or other networks is literally got Jim's name on the cap table. And so when the company wants to interact with their investors, they know exactly who we are. I can take control over my assets because I self-custody them, and I can use it as collateral and Camino. I could lend it out and earn economics that currently I don't get today in the existing system. The company could pay me a dividend or some sort of, different experience that I can't, get in the traditional market. And by processing all of that, from a capital raising, from a distribution, and from a like corporate action perspective, you can programmatically do what takes 5 to 7 intermediaries today to do. So any given transaction when you buy or sell a stock has, a lot of people in between. But when you take a token into DeFi and that eventually will be in an AMM, basically you and I are trading against each other with no intermediaries involved, just code executing the bilateral settlement instantly between the two of us. And so there's a lot of innovation that's exciting about that we can do there, which then blows back, as a positive, I guess ROI to the issuer, which is lower financing costs, lower transaction costs, which just means that the financial system gets better yield, gets better origination, better distribution, and ultimately rewires how the markets are structured so that companies can raise capital from people all over the globe, and they don't have to pay a bunch of people in between to go and find those investors. They can make it available to folks via a smart contract and via DeFi. So I think there's those two different perspectives, like why tokenization will take off is both like the allocators meeting that demand, but also just rethinking how capital markets are structured, and trying to break apart a lot of the existing structure so that because the technology exists now, the ability for markets to be restructured using tokenization is it's in its prime moment in the sun now, given that the regulatory environment is accommodative, and all that I just described on tokenization is has matured to a point where you can attack this multi-trillion-dollar opportunity.
Makes sense. Makes sense. And look, I think in many ways, like, you could hear people talk about it, but actually trying out the technology and using it is probably the best way to understand what's going on. I mean, no different than stable coins, right? I mean, there were a lot of skeptics on stable coins. You try sending a stable coin, you realize, wow, this is 10x better than anything we have in the system today. And so I think, for anyone in the audience, if you haven't tried it, it could be worth onboarding to one of the providers and then trying and buying one of your first tokenized assets just to get a sense for how these things work. So I know we're running short on time. So two quick questions. I'm curious. In tokenization in general, you're seeing a lot of people very excited about where we are from a deployment perspective, the growth perspective. What do you what's a more contrarian view you have on the tokenization space? And maybe a couple of other founders in the tokenization space or other investors may actually disagree with you on in terms of where we're heading, where things stand. Maybe it's something that's overhyped, or maybe that's something that's not appreciated. But anything more contrarian come to mind?
So I think, well, one statement I would make is that I love to see the experimentation and the competition. And I think like this market is so small to begin with compared to, what is there, like $80 billion in DeFi right now? It's come down quite a bit just given the deleveraging over the last, and everybody is just fighting for, a very, very small pie today. And so I think like thinking bigger is where, folks should be really focused on versus the like internal infighting. I do think, that one of the contrarian views that I have is that DeFi will not exist if it's not for RWAs. As a former, member of Compound, this like pains me to say, but like if Compound does not step up and integrate securities, Compound will not exist in 5 years. And so I think you're seeing Aave, Camino, even some of the DEXs that are recognizing that their TVL will be capped at a very low ceiling unless they start to integrate the traditional securities markets, which are, which dwarf the size of DeFi today. And so what's been really interesting that I've been tweeting about and like looking at a lot is stablecoins keep going up and to the right. RWAs at a slightly less, a smaller slope, but eventually will catch up at a similar slope, is going up and to the right. And DeFi TVL is going down. That to me is, I think RWAs are actually existential for DeFi, and partly because like the assets are bigger, the TAM is bigger, but also because like DeFi really struggles with bearer assets in certain capacities, right? Like there's a lot of risk associated with a smart contract hack that doesn't exist. When Aave got into some hot water like a few weeks ago, the parallel market of Aave Horizon, which has 150 million of USTB and USCC in it today, our two funds, completely untouched, just because of some of the controls that are around that. So I do think RWAs are existential for DeFi.
That's great. No, very, very contrarian. I love that last point. So I guess very quickly with the last 30 seconds, would love to just get a quick prediction from you. Where do you think we are? McKinsey, BCG, everyone's talking about multi-trillion-dollar TAMs or RWAs. I think we're going to get there. Let's say we're talking 1 year from now. What do you think the size of the tokenized treasury market is, and in general, the total tokenized, market as a whole, 1 year from now?
I think we'll at least double again on the tokenized treasury market. And that even might be a conservative view. And I think, partly it's because Genius is going to unlock more and more stablecoin issuers that are going to need more and more T-bills. So I think that actually, probably will be a very conservative prediction. But I think what's going to happen, which I maybe is not in the next year, maybe it's in the next 3 to 5 years. What you're going to see is a very large bank or brokerage use DeFi for the first time. And I think
Mm.
that is going to be a game changer in terms of offering unique experiences to your clients that you can source capital, liquidity, leverage using these systems and tokenized assets that you can't, do in the traditional system. And so for me, that will be an explosion of wallets and users on the other side of a very large platform that is now, tapping into liquidity in markets that their competitors are not. And so maybe this is a bad comparison, but like Robinhood came out with free trading, right? And everybody like signed up for Robinhood because they were able to get free trading, and then they built this amazing app on top of it and have done a fantastic job building a business. And I wonder if, brokerages that are like relatively commoditized now might have ability for, hey, you've got a bunch of assets and you want to lend those out. And maybe they'll tap into a DeFi market and lend out your NVIDIA and pay you a lot of the economics or give you the optionality to be able to do so versus, the system that exists today where they eat all those economics and you don't get any of that. And so as a customer acquisition or platform differentiation, I think DeFi is going to be embedded into some of these systems. And that to me is going to be a very interesting inflection point.
Awesome. No, this has been great. I know we can chat for hours, and there's a lot more to chat about, but looks like we're coming up on time. So, want to say thanks again to Jim for taking the time, for sharing some great insights. Encourage everyone to definitely check out Superstate, the blog, the socials, a lot of really interesting stuff going on there. And thanks again to the SEB team for organizing great panel, great event as a whole. With that, let's round out the panel, and thanks again for tuning in, everyone.
Appreciate it, everybody.